get started, first of all, thank you everyone for taking some time out and just attending this webinar. So, welcome all of you. We had the similar webinar somewhere in October where we talked about, or we rather discussed about different year-end practices which will ensure to have a smooth year-end close. So we're gonna have a kind of the repeat the same webinar again, wherein we talk about we in fact gonna deep dive into how the year-end close should be done, wherein we're gonna talk about different tasks, different checklist, best practices, which will let us close our year smoothly. So before we actually get the presentation started, I'm just gonna quickly touch base on some of the housekeeping items. So first of all, we are recording this webinar so that we can share with you. You can then share with your staff, or in fact, we can share with whoever have registered but couldn't just make it. All right. For any sort of questions that you guys have, I will be looking at the chat on and off, but feel free to put them into the chat, and our team will be answering them in real time. This is the first part. Obviously, because this is gonna be a really deep dive, we didn't think that we would be able to finish everything in one go, and that is why we decided to have it in two parts. So this is the first part that we are doing today. And whatever we are sharing in this webinar, like the presentation or checklist or whatever, we'll also be sharing with you, all of you, right? So that's like a really quick the housekeeping items. All right, those of you who don't know me, I'll just gonna quickly spend few seconds introduce myself. I'm Hardik. I'm also an accountant. More, I would say, like more into technology. Like that's what I like about it. I always love playing around apps and new stuff, and so that's what motivated us to create a platform like Xenett. I do come with more than 15 plus years of experience in this accounting industry. And so like we even before solving others' problems, we were trying to solve our own problems when it comes to making the whole review and close process better. And that is how we ended up getting into Xenett. So that's a real quick excuse me guys, I have a bad throat today. So all right, so that's a quick introduction. Now let's just talk about what we're gonna be discussing in today's webinar. We will be deep dive into the entire close process, and when I say deep dive, I'm not just gonna go through the different slides and just talk about it. We do have some live examples where we will share that hey, if this is the thing, here is how you should review, and here is how you should be resolving them, right? So we have picked up some great examples. Based on that, we're gonna be talking about that in these sessions. We do have a detailed checklist which we will share with you, but we also talk about literally going through every single checklist. So it's like if we talk about, let's say, reviewing bank accounts, we even talk about what exactly we need to check while reviewing the bank accounts, right? So just like that, we're going to be going over all the different tasks and checklists that are involved with the year end close. And then we also talk about how to review the financial statements, like how to make sense of the numbers from balance sheet and profit and loss. And the last is organizing the work papers and the review notes, right? So this is like a broadly covering the entire end-to-end close process for the year-end close, right? So before we actually deep dive into the specifics, I wanted to visualize what is actually involved with the whole year end close process. So what we did, like we just segregated it like in a different I would say parts. Number one is more of a cleanup, meaning like routine errors, transactional related errors, which is more like, let's say, some transactions are not coded correctly, or some transactions are yet uncategorized, some transactions could be duplicate, some GL inconsistency, right? So that's more of a transactional errors where it's just more of a kind of fix, bookkeeping related fixes. Then we have some year-end adjustments, then we literally go through every single account on balance sheet and profit and loss just to make sure that the numbers are showing accurate balance. Like that's account balance checks where we go through, let's say, bank accounts, we go through receivables, we go through undeposited funds, and make sure that all these numbers that we are showing in profit and loss or balance sheet are actually accurate. The variance analysis is something that we always do it. It's more to get a feel as to how the year looks when compared to the previous year, right? So it's always good to know like what has changed significantly, like why the revenue numbers has dropped or why the revenue numbers has increased. When we compare it, that also gives us some idea, if at all, because at times there are some year end adjustments that we generally make. So if we are really comparing year over year, that will also give us some idea as to if something is really off. So that's a variance analysis that we do it. And then one of the activity that you also have to do is just want to make sure, if I'm, let's say for example, if I'm right now closing on 2023, I would want to make sure my 2022 is also matching, because I'm very much sure if I don't take care of that, like I'm gonna be questions like question that, hey, why these opening balances are not matching. So let's match opening balance. So that's all leads to eventually more of a tax ready books, right? So this is more like a very high level steps that are generally involved with the year end. All right. So I actually listed down the three main essentials which I personally believe are very, very important for the smooth year end close. Number one, I would say, is more of a the task. Like we need to be very much aware as to what are the tasks or what are the checklists that we have to follow whenever we are working on any particular client. I mean, rather than directly jumping on balance sheet or profit and loss and just jumping here and there, will always leave a room for the errors. So this is personally I follow where I do always have some sort of checklist that I customize for every single client. So I like we have a comprehensive checklist. Using that, we customize it for a specific client, and then we always follow it. We literally follow sign off. So like this is done, this is done, this is done. So that helps us ensuring that we are not missing out on anything. So I would suggest that this is a number one thing that we should have it for the smooth year end close. Second point is working papers. This is also very, very helpful, is because not only this helps us make sure that the numbers that we are showing are accurate by having the supporting documents. This also helps whoever is filing the taxes, right? So imagine if I'm working on the year end close books, I need to kind of send the financials reports to someone who is filing my taxes. Now I know I'm gonna be getting a lot of questions. So what we generally do is that we have working papers for every single account wherever we can, and like attach it to the different accounts and send it to them. So like whoever is reviewing it will can always refer back to the original source. So for example, and by the way, we will be talking more about this in detail later in this webinar, but I'm just touching this real quick. So working papers could be like extract of bank statements or some sort of working like prepaid expenses or how we derive accruals, right? Or we could even put some sort of email screenshot from client, like some sort of loan confirmation that is received in email. So at least we try to put some sort of evidence that justifies whether the balance that we are showing in the books is actually accurate or not. And then the last is review note. I'll highly emphasize this one as well. Review notes mainly to note something unusual. So, for example, if my staff is looking at the bank account and if he or she notices something, we have a practice where they would write it right there. So, if I have a reviewer who is doing a second review, can always refer it. So we just avoid unnecessary back and forth. And not only that, even let's say if you're doing it for the next year, those review notes, those specific observations will always come handy whenever we are also reviewing for the future year as well, right? So I would, for me, I mean, we specifically emphasize on these three essentials. All right. So now, um, this is the number one thing. I don't have to tell you guys, but I know I want to mention this because I have been through this. This is the number one thing that I always check even before start looking at the finances. Like at least bare minimum, the bank and credit card must need to be reconciled because that will make sure, that will ensure the completeness, right? So if this is not done, no point of reviewing anything. So this is the number one thing that we should be doing it. All right. So now I do have slides where I have checklists mentioned for like different categories like bank accounts and receivables. So side by side, I'm also gonna like take you through QuickBooks, and I'm also gonna take you through Xenett as well to talk about how are we going to review them, right? 6, 2, 7, 5, 6, 1. All right, sorry about that, guys. All right, while we get in there, so number one thing that I generally start with is that like from the balance sheet, which is the bank accounts, which is the top one, right? Now it is obviously important to make sure that the banks are reconciled. What is in fact more important is like what are the uncleared items? Like what are the transactions that are causing difference between the bank and the books balance? So easiest way is to go to the reconciliation summary and then just look at it. What are the transactions that make up? So one by one, whatever the accounts are on balance sheet, we would just quickly go through. Or if you guys are Xenett users, there is a unclear transactions entries that we have it here, where it it kind of gives you list of all the unclear transactions across all the banks, so you can have a quick look as to what transactions are unclear. Now, there are certain transactions that you can expect to remain unclear, but then there are certain transactions that you would never expect to remain unclear. Okay, so let's take an example. If there are uncleared checks, and if it is more of a recent ones, like for example, let's say if I'm working on year end, and if I see a check, uncleared check for let's say November or October, I mean it's still okay because I would expect that those checks would get cleared in future, right? But then, if there are some checks which are kind of not clear since few months, let's say March or April, those are red flags, and those checks should ideally be voided because they're not, as such, they're time barred and not gonna clear, right? So this is one thing that we pay attention to because this is a good time also to clean all those uncleared items which are not relevant. And after confirming with the client, we would just kind of write them off. So I'll give an example. For example, so in this case, let's say Bank of America here. I see there is a check from May which is not clear, and we automatically flag it as well, which it's like not gonna clear. So we will end up writing it off. Versus we do have a check which is the most like a recent ones, somewhere in November. So this can clear. So I'm gonna leave it as is, right? So this is number one thing that we will pay attention to, which is the uncleared checks. The second thing is we always look around the transfer entries, or let's say some ACH payments. Like you would never expect a transfer entry to remain unclear in your bank account, right? Unless it's like sometimes it's like the end of the like the last day of the year, and then sometimes it just gets hit on like the very next day. That's very exceptional, but otherwise, if I see let's say some deposit entries which have not cleared, if I see let's say a transfer entries like this which have not cleared from the bank, or if I see some sort of expense entries or ACH or debit card purchases which are not clear, those are like a red flag. I mean, we need to clear those transactions. First of all, we have to find out like why these transactions have are not clear. Is it like duplicate or what, right? And accordingly, we have to kind of get rid of those transactions after getting necessary approval, obviously, right? So these are the main transactions that we generally pay attention to. In a way, the only transactions that I would expect to see is the checks, which are the most recent ones, and at times like probably the deposits, which is probably the last days of the year, which we expect to get cleared in the next month, right? Those would be the only transactions that I would expect to see in the bank reconciliation. All right. So taking you back here. Now, one thing I also pay attention to this one record discrepancy account. Not that I would generally find any transactions in this account, but would kind of be a good practice to quickly have a look at it. So in QuickBooks, you guys would know that you can literally forcefully do the reconciliation, and if the difference is not zero, it's gonna record that remaining amount adjustment in this record discrepancy account. So just for our piece, I mean, we have this checklist where we will just get into this account. Just want to make sure like there is nothing into the like record discrepancy account, right? So that just gives us an idea that this reconciliation was done correctly. All right. So that's like a a bank account reconciliation. Now, while we discuss about the bank reconciliations, I will also talk about the credit card reconciliation together. Now, more or less, the things will be same, but in case of credit card, at times like the statement dates are different. Like sometimes it's 14, 16, 28, it all depends. Now, obviously, the reconciliation would be let's say the reconciliation is done as of 14 or whatever the statement date is. What is more important is that we have to make sure that the transactions after the statement date are also entered, right? Because we have to make sure because those transactions are still falling in the same year. So that's also another thing that we just have to make sure that if there are any such transactions after the statement date, those need to be entered with the credit card as well. Now, ideally with the credit card, we would not expect to see any sort of unclear transactions as such. So that's like a very straightforward. So again, in here, in Xenett itself, we can quickly see if at all there are any such credit card transactions. We can easily look at it and then we can take appropriate action. Now, one thing I wanted to mention here with the unreconciled entries, and this is like with if you are using Xenett. So imagine if as of 12/31st, if there were, let's say, if there were 5 checks and that got cleared afterwards, let's say in 2024, right? Those checks will not show up here. What this would mean is that you are looking at only those transactions as of 12/31st, which are not even cleared as of date, right? So these are the remaining unclear transactions as of today. So that at least filters me those transactions. So if I'm looking at QuickBooks, I still have to look at the whole list. But in here, I'm only looking at the transactions that are yet to be cleared as of today's status, right? So that's a thing I wanted to mention. So this is a thing that I wanted to mention with the bank accounts, and the same checklist that I was showing it to you, we just set it up here inside Xenett. So I mean, same way we'll just kind of quickly pull up the transactions, would have my people follow this checklist and then just sign off. So sign off is also another good practice. Whether you use Xenett or not, that's a different story. But we always used to have some sort of confirmation from the person who is working on this particular task, because sign off will make sure that one is literally confirming that hey, this is done, I have checked this, and we can eventually also set the accountability accordingly. All right, guys, that's like on bank accounts. Any questions? I'm just gonna quickly look at the chat. Just want to make sure there isn't anything. All right, I do not see anything. Feel free, guys. I mean, if at all, if even if you don't have any questions, but if there is something that you guys are checking and you want me to cover, please feel free. Right. So just mention that in the chat. So that's bank accounts. Now, with the bank account, let's talk about the undeposited funds. Okay. Now, with the undeposited funds, the number one thing that I would want to know is the balance. Like, what is the balance as of 12/31st? And what is like what makes up that balance, right? So, let me just pull up the undeposited funds review and then 12/31st. So, this would tell me there's a balance of 1718 and I exactly know what makes up this balance. So now I know that there were two payments somewhere dated in of the March have not been deposited yet, and that because of that we have a balance of 1718. Now with the undeposited funds, I mean as you guys know that I mean apparently it's a clearing account. Ideally we should not have as such any balance in this account, but I think the only time that we would generally have balance is probably the last few days of the month, where the deposits are actually done in the first, like the first week of the next month, right? Otherwise, this account should ideally show zero balance. Now, in this particular case, as we can see, there are two transactions of March which have not been deposited yet. That's what it means, and because of that, there is a balance. Now, one obvious thing that could happen is, first of all, these payments are like duplicated or just I would say just need to be deleted. That could be the obvious thing. The second thing could be is that, and especially with the receivables, it would be possible that probably the corresponding deposit got directly booked to the sales account. And this is one thing I always check. So in this case, I would just look around any specific deposit for 1200 or 580 or even the combined one, because these two payments are like quite closer. So I would just, I mean, in this case, I kind of already set the example. So I would be able to bring it up like 1780. So this is how I would find. And if I like pull any deposit for this amount, which means that this deposit, instead of getting posted to the sales account, should have been adjusted towards those payments, right? So this is one check that we do. Like we look around with the individual amounts or combined amounts, and we just try to see if at all there was deposit, but just coded at some place, right? So again, all we would do is that open the deposit, remove the sales account, and then just match these two payments with those with that deposit, and that will just disappear from here. Anyways, the whole purpose here is to be aware as to what makes up the balance, and as long as if these dates were, let's say, December 27, December 28, I would have been fine. But these dates, like past dated, just don't seem right, right? So these are the things that we should be checking with the undeposited fund. All right. Now the next is account receivable, and I'm also gonna I would say talk about accounts payable together, because more or less we end up checking same kind of thing. So let me just talk about both of them together. All right. So with the account receivable and with the accounts payable, right? The way we would look is obviously open the aging report. Let me just pull up, and then this is one thing I always do, which is instead of seeing or reviewing this report on as of report date, I would rather choose the current, right? So that way we would know what is exactly outstanding as of today, right? And based on that, if we need to make any adjustments, or if we need to provide for bad debts, or like if we need to write off anything, this current status will help us make those adjustments, right? All right. So number one thing that we generally pay attention to is if there's anything zero. So for example, this is zero. So zero means that it's not applied. Like this, there is a bill, there is payments which are not applied against each other, and that is why we are seeing zero. So we just have to kind of apply them against each other, and so they just disappear from this report. So ideally we should not see any zeros here. Number second that we should pay attention to is any negative amounts, right? Negative amounts does not really mean it's incorrect, but it's unusual, right? So we should always pay attention to like why it is negative. It is very much possible that sometimes we may have done an advance payment, and that could be adjusted against the future bills. But as long as we know the reason, it should be fine. Sometimes we have just recorded the payment on account, but the bill is not recorded or accrual is not made, right? So that way, whatever the case may be, we have to make appropriate adjustments for all those negative vendors. That's the second thing that we pay attention to. The third thing is the smaller amounts, like sometimes, like for example, this 0.25. So what happens is that sometimes the payment was done with the rounded off amount, and it just leaves a negligible balance, right? And that just always stays there. So if we see balance like this 0.25, or I mean whatever the threshold that you define, we just have to, I would say that just adjust them so that those don't just, because if we don't adjust it, they'll always hang here, right? So it's also a good practice to pay attention to those smaller balances, and then we just have to take the appropriate balances, appropriate action. Then all right, there's someone who is coming. Then this last one, 91 and over. This is very, very important, right, guys? We always have to find out like which are the customers, like why customers are payables, right? uh I mean, if they are not paid since long, we just have to know like, are this really, should it be really there? I mean, if it is more about we're not going to be receiving the money or we're not going to be paying them, it's always a good practice to adjust them or provide the bad debt or just write off, whatever the case may be. But we should be paying attention to this 90, anything which is 90 plus due. And I mean, obviously, we'll have to consult client before making any of those calls from our end. If there is possibility of receiving payments, of paying them, we can keep them. But I mean, if it is just irrelevant or just been here since like so many years, then it's always a good practice to get rid of those older balances, right? So that's like a very, very important point as well. With the accounts payable, and this is one thing I have noticed, especially for the clients who use some sort of OCR system. So, like the receipts, the client uploads or sends receipt like Uber or Amazon or Home Depot, and like those of cash vendors. So at times, those OCR system would just end up create the bills. Like for example, the vendors like Uber, vendors like Amazon, right? I I mean, you would not want to, like, you would not expect this kind of vendors on your aging, right? So I would also have a quick look as to what are those different vendors, like, and just want to make sure those vendors are not, because in this case, I know what happened was like it got entered as a bill, and then from the credit card it also got directly recorded as an expense also. So like we still have a payables open, we still have an expense here, and then there's a expense from credit card is also entered, so it's clearly a duplication, right? So I would also pay a quick attention to all the vendors real quick, just want to make sure it does not have any sort of cash vendors into that. Okay, so that's like that, and that also helps me at times. I'll tell you how. So I have also found some instances like when I personally go through this, and sometimes like some vendors are created with short form like let's say MA door, like Massachusetts Department of Revenue. So there is like a shortest version, and then someone created like literally like Massachusetts Department of Revenue. So you also have a duplication like that. So I think while we go through these vendors real quick, we can even detect this kind of issues as well, right? So that's on accounts receivable and accounts payable both. Okay, guys. All right. Now let's talk about the clearing accounts. Uh, I mean, even though it says merchant clearing account, but we will talk about the clearing accounts in general, right? So it all depends on what kind of clearing accounts that we are actually dealing with. So, uh, uh, those of you who, let's say, use software like bill.com, I mean, they have their own clearing accounts. And then those of you who deal with like merchants, like for example, Stripe, right? Or Square. I mean, there is also clearing accounts that we have to manage in QuickBooks. Now, as long as we understand how this merchant works or how this, let's say, vendors like Bill.com works, we should be able to kind of like just set the expectation like what should be the balance. So I mean, in our company we use Stripe, so we exactly know the Stripe clearing account at the end of the month should only have the balance that should be deposited in the next month, like the first or second day of the month, right? So typically what we try to do, and so let's say if I just quickly open the balance sheet here, let's say Stripe clearing account. One of the easiest way that we do is just simply open the transactions. By the way, I don't like this new view, but let me just, oh, it's the date. So all we try to do real quick is that I will just pay attention to what are the last ones, right? For example, let's say what are the latest ones that are there, correct? And based on that, I would just do the debit and credit real quick because that will be really easy. I mean, I know you guys would be knowing this, but I just thought to mention it. So for me, a quick check would be if my ending balance, like my this ending balance 1867.12, if it is, I can clearly see the deposit here for the last day of the month, then that is my quick math. As long as if I see similar deposit or even the last 2 days or 3 days deposit, I don't even have to kind of then worry about all the previous transactions. But then if it is not matching, then it could be a problem. Like the problem could be anywhere. So then it's a long exercise that we have to do, like what is getting squared off against each other, and we have to just do some Excel math and then just have to do it, right? But more than that, guys, I think with the clearing accounts, I have seen actually various situations. So to give you an example with the Stripe, so whenever Stripe makes deposit into bank account, they actually deduct fees, right? So we have to make sure that we also account for those credit card fees, because if these deposits are recorded here net of fees, then there will always be difference here, right? So we have to be quite careful whenever we are recording this kind of report, and each merchant works differently. So we just have to know how this merchant works, and accordingly we have to make the adjustments. The second thing that I have also seen is that a lot of clients that I have dealt with is sometimes these clients have taken some sort of loans from these merchants, like Stripe. I know Stripe provides loans, and then I have also seen some other merchant provides that kind of loan. So what they also do is that while they're doing that deposits along with their fees, they also deduct part of the loan repayment as well. So if that is the case, we also have to make sure that in this clearing accounts, we also kind of account for those loan repayment as well, right? Because if you don't do that, obviously your loan balance will be wrong, and then obviously your the merchant clearing account balance will be wrong as well, right? So those were the two things mainly that we just pay attention to when it comes to the merchant clearing accounts. All right, guys, I'm just gonna take a quick pause. Just anyone have any questions? I'm also gonna 1 second, allow the mic as well. So just in case, 1 second, if you guys starting, so if anyone wanted to kind of unmute yourself and ask any questions, feel free, guys. Anything, even any feedback would be good, guys. So yes, so I'll cover that. How do you enter Stripe deposits? I'll certainly cover that. So the way we handle Stripe deposits is that, so okay, and I have a specific situation that I'm gonna cover it. So I have come across a client that they have designed their billing system and they use Stripe as the payment gateway. So the whole revenue gets recorded based on that billing system. So let's take an example. There were $1,000 total of $1,000 that were collected through Stripe. So basically, what all they would do is that the sales would be credited $1,000, and then they would enter the sales receipt for individual customers, and whatever the receivable the other side is, they would put it to the Stripe clearing account, right? So now, when they receive the deposit from the Stripe, they would kind of put it to bank and obviously the Stripe clearing account, right? And this is where the whole thing with the fees and the loan comes into the picture, because when we book the sales, we booked it with the gross amount. At that point, there is no fees or there is no loan prepayment as such involved. So let's imagine, let's say we total total amount or payment that was processed through Stripe was $1,000. But when we actually receive money from Stripe, it could be 970, it could be 950, it could be whatever. So that is when we have to make sure that when we record Stripe deposits, we still book it for $1,000, but then additionally we put the expense line in that deposit, like negative fees or negative loan repayment, and that is how we should be entering it. I hope that I just kind of, I know I was clear in my mind. I tried to explain it, so I hope I was able to explain it well. All right, guys. So we'll just move forward. Yeah, they do the deposits like that. You are right. Obviously, and I think each client works differently. So you're right. I mean, it's not like we will be doing independent deposits as such. They would be doing one in the batch, like, right. So it's like we have to make sure that those deposits get reconciled with the payments recorded by each customer. So yes, you're right. All right, so let's move to the next topic, which is the prepaid expenses. Okay, so with the prepaid expenses, the two things mainly that we would need to kind of, I would say, care about. Number one is it's very, very important to have a schedule in place, which will then help us make sure that we are recognizing the expense correctly, right? So this is one thing that I was talking initially, that I mean, if we just look at the prepaid balance on balance sheet, that would just not mean anything unless we have a schedule or some sort of working paper that justifies like what makes up this particular balance, right? So that's number one exercise that we do. By the way, we do have a schedule for prepared expenses as well, which we'll also be sharing as a resource, uh, like when we kind of roll out along with the recordings. So it's very, very important to have a schedule. So that's number one. Number second is that we also need to find out if there are any such prepared transactions in the books which are actually expense out at present, and it's like not done, not I would say it's not adjusted towards the prepaid expenses. So the most common such expenses could be like insurance, or could be some sort of advertising, or sometimes the software subscriptions, right? So there are some accounts, I mean, based on the nature of business, we should be able to identify it. So in this case, like what I did was I just created a review point here that would automatically find me. So I kind of set some parameters here, like it's gonna look for some accounts like dues and subscription, like rental or rent or insurance. I mean, the accounts could be different. And then I this like put the threshold limit of 5,000, right? So it's like anything that is more than $5,000 in these accounts, I want to see them, because then I can decide whether I want to make the prepaid adjustment for them or not, right? So at least I have those transactions really handy with me. And then by looking at those transactions, I should be able to decide whether I want to make the prepaid adjustment for them or not. So, I mean, this I kind of already built this, so I can see like this. There was a bill which was actually for 2 months, but it just expense out in 1 month. So now we can make the prepaid adjustments, and then accordingly we can recognize the expenses into the accurate month, right? So these were the main two things that we pay attention to when it comes to the prepaid expenses, right? So that is that. Now, the fixed assets. So with the fixed asset, there are a few things that we have to keep an eye. Number one, that if there are any such assets that are expense out but could have been capitalized, we have to find them, right? So basically, it says capitalize the possible fixed asset purchases. So we look around some accounts where probably those fixed assets could have been recorded, like repairs and maintenance. Sometimes we have an account called office equipment as an expense account, right? Sometimes office supplies even, right? So some of those accounts, so in this particular case, okay, I just also have created one view where what it would do is that it would just tell me if there are any such expenses in certain accounts which are quite larger. The threshold limit that I have defined, which is, let's say in this case, I defined $2,000. So those accounts, all those accounts, office supplies, or let's say office equipment or repairs and maintenance, or any of those accounts would quickly pull up, and then I can quickly decide whether I need to capitalize these transactions or not. So that's number one thing that we need to check. Number second is that whatever is already capitalized, if there is anything below the threshold limit, then we also have to expense them out. So to give you an example, let's say it says expense out purchases that is less than the $2,000. I mean, this $2,000 amount could be different client by client, but in this case, in this example, I just mentioned $2,000. So if I see anything less than this amount, like let's say in this case, again, I have a view that would tell me it's a very, very small amount. I'm just gonna put it to expense instead of fixed assets. So that's another thing that we keep an eye while checking the fixed assets. All right. So that's second. Number three is okay. The bills or receipts for new assets purchased. Correct. This is something that we always try to emphasize, and we always try to get from clients. Like anytime, let's say if there is some sort of asset purchase, let's say if it is a car, if it is more of a printers or anything like that, we'll always try to get the documentation for that. And the primary reason for that is we always know like how, I mean, what is the cost, how it was paid, because at times the assets are purchased on, let's say, loans. And sometimes I have seen, in fact, um, the crazy example where I saw there was a car and it only had value of, I think, 1,500 or $2,000. So I mean that is how it was, and all the loan payments that were actually getting paid for that car were actually getting recorded as a lease payment on expense. So it's like the asset wasn't booked correctly. So I think having a documentation would always help us know what is the cost of the asset and the payment mode as well, right? So just in case if uh, the asset was purchased on loan and or lease, I mean that will actually help us record the purchases accurately. Correct. So that's another thing that we always try to look for. And the number four is obviously the depreciation entries. So we just have to make sure we book the proper depreciation entries. So that's these are the four things that we check when it comes to the fixed assets. All right. And then there's the security deposit as well. So as such, we do not expect any movements in this kind of accounts. But if there is anything, then we would want to know like what has changed, uh like why there is a new deposit, or like what is it for, or if at all, if the deposit was written back, then so basically I would say that in this particular case, if the balance remains same, probably it's good to go. But if something has changed, then we should certainly look into it and find out like why or what has changed, right? So that's more of a security deposit. Now, there could be a lot of accounts, guys, where it would be differ client by client. I would try to cover the most common ones, which you generally would find in most of the clients. One of the account that I have not covered here, uh, in fact, I have covered. It's covered here, but not in Xenett. But anyways, I'm gonna cover that, which is the advances for the employees, right? I have also seen some of the errors being done with this kind of accounts. So, number one is that it is always a good practice. First of all, we have to, I would say, define like how to record them, right? So we will always want to make sure that whenever we record any advance paid transaction or advance recovered transactions, we'll always want to make sure there is an employee name mentioned, right? Because if we just randomly open the, let's say, employee advance account, I think there is an account here, okay? There's an account here, and if we do not just simply see the journal entries here and there, it's very difficult to know like which employees owes what, correct? So one of the best practice to manage this is to always have the employee's name associated with the entries, so then we can easily know which employees owes what, correct? Now, some of the errors that I have seen happening in this account is that number one is that it does not have any advance amount paid, but we just see the deductions like this negative amounts, right? In this case, there are advance amounts, but what happens here is that I have seen that the employee cash advance account shows negative balance. And that is because we have only recorded the advance that was recovered as a part of payroll, but not the one that was actually paid. Right. And in this particular case, I've come across a lot of situations where the advance was given but coded as reimbursement or coded directly to salary expense, right? So obviously you do not have advance recorded here, and that's gonna throw the balance off, and that's just gonna have the balance like a negative balance. And a lot of this payroll system, if used if used correctly, can actually give you the exact advance amount by employee, right? The way I would prefer to look at this one, employee cash, let me see if I just can pull it up. Employee cash advance is that I would want to, okay, here is a good one, okay? This is what I would do. I would just simply group it by name. So now I exactly know who the advance was given to and what is the repayment here. So I can clearly see the advance was given to David, 1200 we have been deducting every pay period, so which is fine. In this case, Patrick, there is deduction, but there is clearly no advance given. So most likely the advance was coded to the wrong account, right? So at least now I have the entire ledger break or grouped by different employees, so I can then find out what is wrong and I can accordingly fix it. But this is only possible, guys, if we are just assigning the names to every single transactions, right? So anyway, so this could be the potential mistakes that could happen with employee cash advances as well. All right, so these are the main assets. I would just quickly want to see just a second if I'm not missing out anything with the asset. Oops. So I actually mainly wanted to talk about the assets on this session, and that way we can then talk about the liabilities and the equity in the next one. So I'm just kind of quickly going through. And one thing, guys, I think we have to pay attention to is this cleanup. So those of you guys are already using Xenett, this cleanup more will take care of your routine bookkeeping things. For example, if and these are I would say some of them will not literally throw the numbers off, right? So even before we actually just jump around and all like look at all the balance sheet accounts, this is a quick overview that would tell me. So like imagine I would come here, I would see, let's say there are zero uncategorized transactions, zero transactions, uh, no duplicates found, right? So I mean, this is also gives me an idea like, oh, all these things are clean. So now when I'm looking at the, let's say, bank accounts, credit cards, or undeposited funds, those are already to a greater extent, it's already clean, right? So I would just come here first and then go over all of those review points and make sure that these, first of all, these are cleaned up, and then this will automatically take care of a lot of issues that would come after like or while reviewing balance sheet or profit and loss, right? So these are many of pretty very straightforward that you guys are already doing it, uncategorized or transactions missing the pay name, possible duplicate transactions, or something is miscoded and all of it. And I'm going to talk about some of these important review points in our next webinar, because I wanted to cover them, and along with the liability and equity, right? So I'm gonna end here, guys, for today's webinar. I hope you guys found it helpful. Would love to know the feedback. I was expecting some questions, so I at this point I do not really know whether it's helping you guys or not helping you guys, or so even if it's a some sort of criticism would always be also be welcoming that. So just let us know if there's anything that you would want us to cover more in detail, or like with the like more examples, would be happy to do that as well, right? So I hope you guys found it helpful. Thank you very much, guys, for your time, and I'm looking forward to seeing all of you in the next webinar. Thank you, guys. And yes, once we are through with the entire webinar series, we will then be sharing the recording along with all the resources that we have it. Yes, so we will be sharing the dates. It's going to be the next week. So you will be receiving the invite for that as well. Yes, so. All right. Thank you very much, guys. And you have a great one. Bye bye. Take care.